Did you know that there's an investment strategy that has beaten the S&P 500 for 8 years in a row? That's right. While most investors struggle to outpace the market, this approach consistently outperforms, giving you a real shot at building wealth faster. If you're tired of watching your money underperform or feeling left behind, this video could change everything. I'll reveal the secrets behind this proven strategy and how you can start applying it today. Make sure to like and subscribe so you don't miss out on these game-changing tips. Now, let me show you why this is so urgent and what you need to know before getting started. Today, we're revealing an investment strategy that has beaten the S&P 500 for 8 consecutive years. If you're someone looking to improve your financial growth and make smarter investment choices, this video is for you. We'll break down how this approach works, why it has outperformed the market consistently, and how you can apply it to your own portfolio. Whether you're a beginner or have some experience, you'll walk away with clear insights into this proven method and practical steps to start implementing it today. Understanding this strategy is especially important now, given the current economic climate in the U.S., where market volatility and inflation challenge traditional investing. By the end, you'll have a new perspective on how to position yourself for better financial results. But to make smart decisions, you first need to understand the economic landscape we're dealing with. Over the past 8 years, an investment strategy has consistently outperformed the S&P 500, but understanding the environment in which this success occurred is crucial. The U.S. economy has experienced significant fluctuations, driven by factors such as inflation, interest rates, and market cycles. According to the Federal Reserve, inflation peaked at 9.1% in June 2022, the highest in 4 decades, prompting the Fed to raise interest rates multiple times in an effort to control rising prices. Higher interest rates have increased borrowing costs, cooled off overheated sectors, and shifted investment flows. Meanwhile, the labor market has remained resilient, with the Bureau of Labor Statistics reporting a low unemployment rate of 3.8% in early 2023. However, rising mortgage rates, up from around 3% pre-pandemic to over 6% today, have cooled the housing market, affecting consumer wealth and spending. Tax policies have also shifted, with some changes aimed at incentivizing certain sectors or investments, influencing market dynamics. These macroeconomic factors create a challenging environment for traditional investments, with increased volatility and uncertainty. Market cycles are more unpredictable, and inflation erodes purchasing power, making it essential for investors to adapt. The success of a strategy that beat the S&P 500 for 8 years lies partly in navigating this complex landscape, capitalizing on opportunities that arise from these economic shifts. With that context in mind, let's break down a strategy you can actually apply. This investment strategy has consistently outperformed the S&P 500 for 8 straight years by focusing on flexibility and adaptability in changing market conditions. The core idea is to identify opportunities that others might overlook during times of volatility and uncertainty. Instead of sticking to traditional buy-and-hold methods, this approach emphasizes active management, constantly adjusting investments based on current economic signals. The process begins with understanding key terms like market trends, which are the general directions in which the economy and stock prices are moving, and risk management, which involves protecting your investments from unexpected downturns. The strategy uses these concepts to decide when to buy, hold, or sell different assets. When the economy shows signs of strength, the strategy invests in assets likely to grow quickly. Conversely, during downturns or uncertain times, it shifts to safer options to minimize potential losses. This approach also involves analyzing economic indicators such as inflation rates, interest rates, and employment data. These indicators help predict market moves and inform decisions about where to allocate resources. The goal is to stay ahead of the market by being proactive rather than reactive, capitalizing on opportunities created by economic fluctuations. In simple terms, it's about actively managing your investments based on current economic signals, rather than relying solely on long-term predictions. This flexible, responsive method has helped generate better returns, even during turbulent times. Now let's look at a real-world example to see exactly how this plays out in practice. Imagine you buy a rental property in Dallas for $300,000. Using Zillow, you find comparable homes in the area rent for about $2,000 a month. That means your annual rental income is roughly $24,000 before expenses. You finance the property with a 20% down payment of $60,000 and a 30-year fixed mortgage at 5% interest. Using a mortgage calculator, your monthly mortgage payment would be approximately $1,610 or about $19,320 annually. Subtracting your mortgage payment from rental income leaves you with around $4,680 per year before accounting for property taxes, insurance, maintenance, and vacancies. Let's estimate these costs at $8,000 annually. This results in a net cash flow of roughly minus $3,320 the first year. However, the property's value appreciates at an average rate of 3% annually, increasing your equity over time. Additionally, your mortgage payments build equity as you pay down the principal, and property appreciation adds to your total return. Over 8 years, assuming consistent rent increases and property appreciation, your equity could grow by roughly 25% and rental income could rise, improving cash flow. This approach leverages financing to amplify returns through appreciation and rent increases, outperforming passive investment strategies. But remember, this looks great, but only if you avoid the common traps that ruin deals like this. Many investors believe that simply buying and holding is enough to beat the market. But the truth is that small mistakes can derail even the best strategies. First, rushing into investments without proper research can lead to overpaying or buying assets that don't fit your goals. For example, several years ago, I knew someone who bought a property just because prices were rising, only to find out later that they hadn't checked the neighborhood's long-term prospects. Second, neglecting to manage your credit and financing carefully can result in higher costs and lower returns. Taking on more debt than you can handle, or not shopping around for better mortgage rates, often eats into profits. Third, skipping due diligence, like ignoring market signals or economic data, can cause you to miss warning signs or opportunities. I've seen investors hold on to assets during downturns, only to watch their value decline further, simply because they weren't paying attention to changing conditions. Fourth, emotional decision-making can lead to panic selling during market drops or overconfidence during booms. Staying disciplined and informed helps avoid these pitfalls. Lastly, failing to diversify or adapt your strategy as conditions evolve can limit growth and increase risk. The most successful investors continuously learn, adjust, and avoid these common traps. To avoid those mistakes, here are the best tools and resources available right now. Imagine an investment strategy that has outperformed the S&P 500 for 8 straight years, even through market volatility. The secret lies in a flexible, proactive approach that adapts to current economic signals and manages risk intelligently. To implement this, you need the right tools at your fingertips. First, consider using Yahoo Finance, finance.yahoo.com. It provides real-time market data, economic indicators, and news updates, helping you stay informed about inflation rates, interest changes, and employment figures, key signals for adjusting your investments. Next, Morningstar, morningstar.com, offers in-depth analysis and ratings on stocks, mutual funds, and ETFs, assisting you in identifying trending assets and avoiding impulsive decisions. For real estate investments, Redfin, redfin.com, is invaluable for evaluating property values, market trends, and neighborhood data, supporting strategic property acquisitions like the Dallas rental example. Lastly, for financial planning and tracking your portfolio, Personal Capital, personalcapital.com, combines account aggregation with personalized advice, keeping your investments aligned with your goals. These platforms empower you to make data-driven decisions, stay disciplined, and adapt your strategy proactively. Key components of beating the market over the long term. Now that you've got the tools, let's talk about the first thing you can do today to get started. Imagine a strategy so powerful it has beaten the S&P 500 for 8 straight years. It's not about luck or timing the market perfectly. It's about making smart, proactive choices that adapt to changing economic signals. The good news? You don't need to overhaul your entire financial plan overnight. The first step is simple and within your reach today. Start by checking your credit score or downloading a financial app like Personal Capital. This small action unlocks a clearer picture of your financial health, helping you understand where you stand and what adjustments you might need. It's the foundation for smarter decisions and keeps you engaged in your journey. By taking this initial step, you're creating momentum. Each small action builds confidence and reinforces the habit of mindful investing. As you become more familiar with your finances, you'll be better equipped to analyze opportunities, manage risks, and adjust your strategy over time. Remember, every long-term success story begins with a single, manageable step. Whether it's reviewing your expenses, simulating an investment, or setting financial goals, your actions today set the stage for future growth. Stay consistent, keep learning, and watch how your efforts compound over time. The journey to outperform the market starts now. Are you ready to take that first step? Imagine yourself 5, 10, or even 30 years from now, having followed a disciplined, flexible investment approach. Over time, your consistent adjustments and risk management have allowed your portfolio to outperform the market, even during turbulent periods. Picture the compound growth of your investments, quietly working in the background, steadily increasing your wealth. Maybe by 2035, you own 5 cash-flowing properties, generating reliable income and building real assets that secure your future. Or perhaps your diversified portfolio has grown substantially, providing the freedom to pursue your passions or support your family comfortably. The key is that this success isn't driven by luck or short-term gains, but by a steady, long-term strategy that adapts to economic signals and stays disciplined through market ups and downs. It's about making small, consistent actions today, checking your financial health, adjusting your investments, setting clear goals that compound into meaningful results over decades. And the good news? Anyone can start now. By embracing this mindset, you set yourself on a path to financial resilience and growth, no matter what the market throws your way. And now that you see what's possible, here's how we wrap this up and take action. And that's how this simple yet disciplined investment strategy managed to beat the S&P 500 8 years in a row. The key lesson? Flexibility, consistent adjustments, and a focus on risk management can turn market fluctuations into opportunities for growth. Thanks for sticking with me and celebrating these wins together. Remember, building wealth isn't about luck. It's about smart, steady steps every day. If you found this helpful, hit that like button, subscribe for more insights, and drop a comment below. What's your first financial goal for this year? I'd love to hear from you. And if you want to dive deeper into how to optimize your investments, check out my video on the psychology of wealth building. Stay confident, stay disciplined, and keep pushing toward your financial freedom. See you in the next one.